The collapse of Credit Suisse, one of Switzerland's most established banks, was announced recently after a series of financial losses and scandals. As a result, UBS took over the company for $3.23 billion, a deal supported by Swiss authorities who aimed to prevent a global banking crisis. UBS also agreed to assume up to $5.4 billion in losses suffered by Credit Suisse as part of the takeover arrangement. Why did this happen? Also, amid global financial turmoil, how have Indian banks cushioned the impact? Are there any lessons for European central banks to take from the RBI? Credit Suisse's financial woes began 2 years ago when it suffered losses from Greensill, a British financial firm that specializes in short-term corporate loans. The bank had invested heavily in the company and subsequently incurred losses when it went bankrupt in March 2021. Credit Suisse closed 4 related funds in which it had invested $10 billion. Soon after, the bank lost an additional $5 billion when the US hedge fund Archegos collapsed. Another significant event that led to Credit Suisse's demise was the Mozambique bribery scandal, in which the bank was accused of providing loans to 2 government-owned firms in exchange for bribes. The bank was fined $475 million by British and US authorities. Additionally, Credit Suisse's reputation was damaged by the Swiss Secrets media investigation that accused the bank of holding billions of dollars of black money for decades, an allegation the bank denied. Credit Suisse also faced COVID-19 guideline violations by its chairman Antonio Horta Osorio, which forced him to step down after just 9 months on the job. Furthermore, the bank was found guilty of prioritizing revenue generated by Patrice Lescaudron, one of its top bankers, over the interests of its clients. Lescaudron was sentenced to 5 years of imprisonment in 2018 for forgery and fraud, and the bank was ordered to pay $553 million in damages to former Georgian Prime Minister Bidzina Ivanishvili. Now coming to India, recently RBI Governor Shaktikanta Das reassured the public that the Indian banking system remains stable and resilient. The collapse of the 2 banks in the US has not had a systemic impact on Indian banks, but it has impacted bank shares in India. Depositors and investors are worried that the failure of a large bank anywhere can have a contagion effect across the world. The rise in interest rates led to problems in the bond market in India. As yields on a security go up, its price goes down. Such a rapid rise in rates in such a short time caused the market value of previously issued bonds to fall. This has affected the Indian market, with the yield on India's benchmark 10-year government bonds declining by 6 basis points to 7.35%, registering a fall of 11 basis points in less than a week. The yield on 5-year bonds fell to 7.30% before closing at 7.33%. The safety of depositors' wealth is another concern for investors. The failure of Silicon Valley Bank and Signature Bank in the US raises questions on the safety of depositors' wealth everywhere. Unlike in the US, where a large portion of bank deposits are from corporates, household and retail savings make up a bulk of bank deposits in India. However, the government and the RBI had stepped in when some private banks like Lakshmi Vilas Bank, PNC Bank and Yes Bank faced problems in the past few years. In India, deposits up to Rs 5 lakh are insured with Deposit Insurance and Credit Guarantee Corporation. This means a depositor with Rs 50 lakh in a fixed deposit will get only 5 lakh rupees if a bank fails. However, the RBI has classified SBI, ICICI Bank and HDFC Bank as DSIBs. These banks have to earmark additional capital and provisions to safeguard their operations. The Reserve Bank of India has stringently followed the Basel norms for transparency and capital adequacy. According to experts, India's macroeconomic indicators are improving day by day, and it can stand out in this global financial turmoil. The RBI's Financial Stability Report, released on December 29, 2022, warned that risks from global spillovers and financial market volatility remained in the high-risk category. However, it also said that stress test results reveal commercial banks are well capitalized and capable of absorbing macroeconomic shocks even in the absence of any further capital infusing by stakeholders. Banking regulations in India are strong, and Indian banks must make provision for all unrealized market-to-market losses outside their held-to-maturity or HTM portfolios. Most private sector banks in India have a relatively small HTM portfolio. According to analysts and experts, Indian banks have seen a boost in their profitability in the recent past, thanks to the improvement in asset quality and robust growth in credit. Though it is expected that there will be some pressure on margins as deposit rates go up, banks are in a much better shape to cushion its impact. The collapse of Credit Suisse has had a significant impact on the global financial market, including India. Indian economy is confronting strong global headwinds, yet sound macroeconomic fundamentals and healthy financial and non-financial sector balance sheets are providing strength and resilience and engendering financial system stability. India's macroeconomic indicators are improving and its banking regulations are strong. India's banks are capable of safeguarding themselves on the back of strong banking regulations, and they are in a better position to cushion the impact of the rising deposit rates.